So there's quite a lot of things happening, not just here, but also in the financial markets. In fact, it's been chaos. There's been contagion from the failure of Silicon Valley Bank. There's the interest rates being hiked. So you want to think about things as wondering where the root of the problems were. Some people think that the root of this recent banking crisis actually was the Federal Reserve. If Jerome Powell had not raised rates by so much, would the banks have failed? Now, for some insight into that and what the Federal Reserve is going to do next, we have two very, very talented gentlemen. First off, with Mr. Kelwin Li from Phillip Securities, and later Mr. Marcus Ng from Societe Generale. But first, we're starting with Kelwin. Please give him a big round of applause.
Hi, good afternoon, everyone. All right, I hope you all had a good lunch. But at the same time, don't get too comfortable as you see in this picture, right? Okay, you don't want to be looking like this on Monday. All right, so hopefully you pay full attention to whatever I've got to say, and then hopefully we learn some stuff or some little tips as we go along to tread this market. All right, so from the picture here, right, who feels like this for the last few months or even the last year? Can I just have a show of hands? Who feels like that? Or is it nobody's invested in the market? Everybody's all safe and sound, all right, not looking like that. Because I can tell you for sure, I'm a bit like that also. All right, even if you're trading in and out, sometimes you do get hurt due to the volatility. All right, so even sometimes you're long-term also, you're thinking, wow, how long? All right, you feel as if you got punched. All right, so today we're just going to dwell a little bit how not to look like this. All right, so hopefully you pick up some key pointers along the way. Okay, as usual, the disclaimer, whatever I share here does not represent Phillip Securities. It's just my own view. It's not a solicitation to buy or sell. All right, I'm just sharing my view. Of course, everybody has a different view. All right. Okay, as usual, if you have any questions, go to pigeonhole.ad. All right, fill in your questions, and then at the end, Marcus and I will just do our best to try to answer the questions. Okay, just a little introduction on who I am. All right, I'm from Phillip Securities. I've got close to 12 years of experience in Phillip. We're serving over 1,500 clients. All right, and recently in my 12 years of career, I've won a few awards from Poems from Phillip Securities. And also we got a blog. All right, so if you want, you can just head over there to get more information on the markets. All right, and from time to time, I also do contribute to Cao Bao, writing up interviews and all. All right. Okay, this is my personal contact. We're on Facebook. We've got a blog, so anything you can just find us over here. Okay, what I'll cover here today, okay, the US macro and the Fed policies, right, to fight them or not to fight. Okay, the impact of Singapore also. All right, what happens in US? Definitely we have some impact in Singapore, all right, and our banking sector. All right, after that, I'll take a look at some of the common indices, all right, your S&P, NASDAQ, Hong Kong, all right, and our STI. And lastly, we have our Q&A. Okay, let's take stock. All right, what's happening? What has been happening for the last year? As we know, Fed has risen rates up 7 times in 2022, all right, and 2 times this year. All right, so we can see the rates has gone up to about 5%. It's quite painful if you're holding a mortgage loan, right? These days, I get a lot of comments from friends. Wow, interest rates starting to hurt. Okay, I can see a lot of people nodding also. All right, I do personally feel it. I can tell you as much. Okay, this is also a quite important data. All right, we got our CPI, and this is what Fed looks at actually, your PCE. All right, the core PCE. The good thing is we can see it slowly coming down. All right, we know that the Fed rates wants it to be at 2%. We're at 4.7. Interest rate is at 5. Okay, but it doesn't mean it has to double. Then this one slashed by half. Okay, it doesn't work like that also. Right, it's a lagging indicator, but just let's take stock that inflation is slowly coming off. That's good news for everyone. All right. Okay, the unemployment rate. At the same time, there's inflation. We also want to look at the unemployment rate because this is important for Fed. All right, we are about 3.6 for unemployment rate. That's rather healthy. All right, we cannot bring it down to 0.1. Right, in any full economy, there's always some unemployment rate. Okay, right at the recession high in the financial crisis, it was about 10%. All right, so at 3.6, the Fed thinks it's still healthy. All right. Okay, this is a very interesting chart. Just take a few minutes just to analyze what happens whenever Fed increase the rates, because these are very major event driven. So we just want to take a little look. All right. Over here on the first rate hike, okay, let's try to see whether we can spot any patterns in this. All right, when we first rate hike, what happened? Actually increase, right? The market go up. A normal retailer or consumer would think, hey, when the rate hike, it should kind of come down, right? So actually it goes up. Okay, the second time, it went down. The third time, it goes up. Fourth time, it goes up. Fifth, sixth, seventh, eighth, ninth. Okay, from here, do you see any patterns? Can anyone of you here spot any patterns? Or there's actually no patterns to it. So the real thing is don't fight in some ways, right? We can't really spot a pattern. Okay, so what I see here is really on these days, we have to be very fast, very nimble. If you are taking a trading position, later Marcus will go over with you some of the instruments that you can be using whenever you hit such major events. All right. We can see here at no point trying to predict will it be 0.5, 5, 0.75, what the market says. Right? Because the news out there, it can be very distracting. You read one source saying might be 0.75, another source say 0.5, another source say 0.25. Right? By the time you read it all, you get a headache. Okay, you don't know what to do. Right? So on this time, the good thing is we can see there's always a very long bar on such events. All right. So if you are a fast trader, you can actually scalp the market. You can go in and out intraday. There are instruments that allow you to do this, right? Of course, with care, with proper knowledge, you are able to take advantage of such volatility, right? Volatility is really good for traders. When it goes up, goes down, all right, you can take advantage of that spike. Okay, you don't want the market to be just flat like that, then it'll be very boring. All right, so if you're looking into trading, right, these are just some hints on what you can do the day before or even the day after. Right? One good thing is that the market actually gives you quite a bit of volatility, quite a bit of length. On the days when it's announced, you see a very long bar. All right? So with that, you can actually take advantage of the swings. All right? Anybody any questions right now? All right. So why the Fed is doing this? Okay, the Fed's just given two simple goals. Right? Firstly, to maximize employment. Okay. And second, to keep price stable, meaning inflation rate at a stable rate. And they have targeted at 2%. Okay, why 2%? Don't ask me. It's been throughout history. They have actually come up to a point of 2% that they have done studies. Whether 3% is also possible, there have been studies going on. Whether 2% is actually ideal. Right? Actually, the real source, I think, came from Canada. Right? That they've agreed on like 2%. So even Singapore here, later I'll show also we are looking at 2% inflation rate. All right. So the good thing is we're almost there in terms of interest rates because we're at 5%. The terminal rate for Fed so far is around 5.1. All right. Whether they will change, I also cannot say. Right? They changed it once, right? Previously from a bit lower, and they realized inflation is not coming down, so they said terminal rate has going up to 5.1. All right. Okay. What interest rate might look like in the future? All right. These are just some probability stats that we might not see that high. All right. Most people are guessing it's around 5.5%. All right. Then after that, everybody is hoping for a rate cut. Whether it will come, it really, really depends on the inflation data. All right. Okay, so what happened on 22nd March, just last week? Right, good thing the Federal Reserve actually went ahead with 0.25. Most market participants were actually pricing in a 0.5%. Right, because the inflation data kind of creeped up in February, right? Everybody's kind of worried the inflation will start coming up because, I mean, China is opening up also, right? There can be more demand from there, and etc. And unemployment is stubbornly low, right? So people are still having jobs, people are still spending. Okay, so, but the good thing is, all right, the central bank is calling it call time, my call time on its monetary tightening policy soon. All right, and so also inside here, it's very important to see what he says, right? His posture, his stance. All right, whether he's going to be very hawkish or is he going to pull back, down. That's where the market start to take hints. And then market starts running ahead of it. So that's why you always see a lot of bad news coming out, but market's still going up. Okay, so they're all pricing in a bit of a rate hike or a rate pause. Okay, in his statement also, he did say that we're going for one more rate hike for this year. When? We also don't know. All right, so at least there's some clarity, there's some certainty. That's why you see market is actually holding up for now. All right, and then what happened? Another twist. All right, life is always very uncertain. It's very exciting to be in the market. You can ask my wife and kids every day, like, well, what happened today? All right, before we know it, before long, we saw all this, right? By now, I'm quite sure you have seen these pictures, this news in the news for so many times, you can recognize all these symbols already, right? SVB, Signature Bank. Oh, but the good thing is, Temasek says this doesn't have any exposure, all right? No, it's going to be a big storm again, right? Like the whole crypto, okay? And at the same time, we also have Credit Suisse, right? Who needed some bailing out. And we also, last night, I think if you saw the news, Deutsche Bank was also slightly in trouble. All right, you saw the share price coming down, but towards the end, it actually recovered. Okay, so this banking crisis, if you ask me, I don't think it's over yet. All right, you still have a lot to uncover. All right, so we're only kind of at the start of it. Okay, so there actually is still a bumpy path, right? We're not over yet. And through the studies also, we've got another 186 more banks that kind of look like might be in trouble. All right, how big it is, we all really don't know. All right. But once again, Fed to the rescue. Okay, good thing this time around, the Fed acted early. All right, if you wait longer, all right, there might be more spread. Okay, things could have gotten worse. So the good thing about now Fed, right, they're more well informed. They can act faster, so the market don't react so violently. Okay, so you can see Fed and the other central banks all stepped in together to have joint operations. They spent over 300 billion, which actually also kind of wipe out the whole QT, right? So as if they went for another QE. That's why you see the market is actually holding up. All right. At the same time, to add on this, we also have more recession fears. Okay. This year, about 61% says there's a recession, that the economy might go into a recession. All right. And if you look at the yield curve model, all right, when the short term hits the long term and stuff, right, we do good chance to see a recession this year. All right. But the thing is, depending on where you are, all right, just one last slide for this. The growth also in the US is also starting to slow down. All right, this year, the real GDP for US is forecasted at about less than 1%. All right, so it's going really slow. All right, you can see that, right, even from Q3, you'll start seeing it coming off. All right. Okay, but the good thing, if you're a long-term investor, all right, this is talking about a bit more investing. Okay, last year we had a negative year. All right, we faced one of the worst year. Okay, we can see that the next year, there's a tendency that we might see an up year. So last year was negative. This year, good chance, okay, we might see actually a rebound. How will it happen? How will it play out? We still got another 9 more months to it. Okay, but there could be also a occasion when it's a double decline. And if this year is another year of decline, it will be worse than last year. So hang on tight. All right. But the good thing again, if there's such things that happen, all right, you can take advantage of that volatility using various instruments. Okay. For the long run, if you can see, right, S&P historical performance, okay, it's been up 33 years. So for the long run, for long-term investors, you don't have to be overly worried. All right, take some chance when it's coming down to actually add a little bit into your portfolio. All right, so this is our view. Okay, interest rate is actually nearing terminal rate. Okay, one more rate hike for 2023, which is not too bad. All right, so that's good news. Okay, the only thing is inflation's a bit high, but at the same time, it's still a bit lagging. All right, it takes a few more months to see whether it's really finally coming down to 2%. Who knows, the narrative might change. They might go for a bit higher, all right, more than 2%. Okay, the general market sentiment, as I talk to my clients, everybody is still very fearful. All right, everybody, even as a consumer, you're tightening. Even I myself also, as I'm spending, I'm also tightening a little bit. But let's not eat out so often. Let's eat at home a bit more. If I eat at home also, cook also a bit more expensive. I ordered Cai Fan also nowadays, got a lot of stir, right? Well, this one the Cai Fan, this one's so expensive. All right, so everybody's feeling the pinch. Okay, I can see from expression, everybody's all nodding and yes, we understand that. Okay. Same time, portfolio managers also, the allocation actually at the historical low. All right, so fund managers are also a bit unsure. Okay, recession risk for the market is also quite high this year. All right, and at the same time now, we also have something thrown into the mix. We have the banking risk. It's not as if like the world is already not chaotic enough. Then now we have another risk there, all right? Okay, the good thing is the US, if you do a valuation, it's kind of fairly valued. It's not undervalued. So it's not overly expensive at this juncture, all right? Okay, this is more on a technical basis. As you can tell, a lot of people ask me, how come market is still going up? So chum, every day the news coming out is very bad, very bad. All right, so the market actually climbs on a wall of worry. Okay, that's how, usually that's how, sometimes the retailers are a bit on the losing end, right? You reach too much news, you get intoxicated, then you're like, oh yeah, very bad, very bad. First thing that come out of our mouth is, well, Hang Seng Pai, right? Economy very bad. Okay, that's what I hear a lot from my clients. So I try to, let them see from another angle. All right, so we might see a positive year since everybody is so bearish. But I'm not trying to be a contrarian for the sake of being a contrarian. All right, so there are like stats backing it up. Okay, and now at the same time, I need to come back into our local context. What happened with all that's happening in US? Okay, so the impact on our Singapore economy. All right, we see the MTI. All right, see a growth forecast of only 0.5 to 2.5%. All right, so last year we did better because all the revenge traveling. People are very hungry for traveling. Even I myself also hurry up go. The moment I get COVID, I book a flight already so I can travel. All right, so but this year a bit tightening already. Cannot travel so much. All right, maybe go to JB. All right, so we can see that over here in their statement, the banking segment also contracted on the back of fall in net fees and commission alongside a weakening of lending activity. So you can see in Singapore, our lending activity also is starting to slow down due to whatever's happening in the world, right? The loan books, as you can see, also is slowing down, right? Singapore Bank is facing a slower loan book. Reason because interest rate is very high. So I talk to my friends, also everybody's like holding off purchasing property, right? Who here looking to purchase property and stuff? Okay, the interest rate is a bit high, so a lot of people are like just holding back, waiting, playing a waiting game. Whether is it or not, you should wait. I'm not a property expert. I can't answer that question. Like, I won't attempt to answer that question also. All right, so Singapore is a little different. All right, our approach to monetary policy, okay, is we don't control our interest rates. Okay, there's about 3 choices. We chose 2 instead of 3. So we cannot determine our interest rates or the money supply. So interest rate is left largely to the market forces. So technically, we kind of follow the US. Okay, we buy and sell our Sing dollars in order to control our exchange rate, which in turn help to control the inflation. So Singapore is different in that aspect, right? So you can always see MAS coming up the band, the monetary band, all right, where the FX can float. Okay, if it's too high, we try to bring it down. If it's too low, so you want to control inflation, we try to bring it up, right? So when exports is more cheaper or more expensive, people might stop buying, importing, and exporting. All right. Okay, for 2022, our inflation numbers also came in 6.1. All right, CPI 6.1. Core, all right, this takes away transport and housing, a com at 4.1. Okay. Yeah, more very gloomy news around Singapore also. Manufacturing gloom in the first 2023. All right, so overall it looks a little gloomy, it looks a little bleak in Singapore. All right, our inflation also still at 5.5, right? Still a bit relatively on the higher side. We're trying to bring it down to 2%, all mainly due to interest rates as well, like what I said earlier on. Okay. As you can see also how this has already taken shape, taken effect. If you've seen the news recently, all right, in Geylang Serai, the bazaar, right, we have many more empty stores, right? And if you've seen the news also, I think one of the store owners paid about 18,000 a month, right, for the rental. Who saw that news? All right, so that was a bit of a shock, right? For the same space, you're saying for the same space, the same location, now he has to pay 18,000. All right. And then after, I think followed by, he said he had to increase 10%, 10 cents per item. Yeah, so inflation all is getting real. All right. So when you go for the bazaar, please help support. Huh? All right. You're going to spend a little bit more over there. All right. So impact on Singapore economy. All right. We got headwinds. Okay. Our local business probably be very, very challenging for them. All right. Because to service your debt will be harder. Right. Construction firms also, they rely a lot on borrowing, and borrowing costs right now is on the high. All right. If you are a saver, right, for everyone, you'll be pleased because as you can see, banks are competing for deposits. All right. You can see the interest rate has gone up for a lot of deposit. Right. At the same time, it can be a double-edged sword because a lot more people are saving and you're not spending. All right. We kind of have to spend our way through a recession, right? If everybody's saving, then who's spending? Okay. So naturally, consumer will be spending lesser, and worst case scenario, we might see some job loss starting. Okay, and also the news. This one they try not to report too much, not also look a bit more worrying. Okay, there's actually more. That's why I put it at the end. Okay, actually you can see that more homeowners are also defaulting on the mortgages. As it gets more expensive, it's going to be more expensive to service your loan. Okay, and over here the news, right? Spending is starting to slow down in 2023. All right. Okay, impacts on Singapore REITs. There'll definitely be impact, as we can see the REITs also have already come off from its high, all right, due to the interest rate increase. But all not is it's not all doom and gloom. Okay, because REITs are not all made the same. So as an investor, as a trader, you look for the more quality ones. Okay, look for the sector dynamics. Different sector will perform differently. For example, your hospital REITs, right? Be good time or bad time, all right? Whoever need medical treatment will still go there, right? If you got something major, doesn't matter whether recession or not, you have to get it fixed, right? If unfortunately, if you have cancer or what, right? You can't tell the cancer, hey, now recession, I think maybe we hold on a while. Can? All right? Maybe 1 year later, we revisit the cancer. Hopefully you're still around now. 1 year. Yeah, all right. Okay, quality of it, the gearing ratio. Okay, it's all important in choosing it. Okay, impact on Singapore banks. We're also filling it. Right, recently I've seen most of the banks actually after their results coming off because of the forward statement of their CEO mentioning that they do see a slowdown in their loan books. All right, but the good thing is there's a lot of people asking me also how are the banks. All right, in the recent survey in 2022. Right, these are actually the top, the Asian banks actually rank in one of the top 20, right? Okay, our 3 local banks over here, on a technical perspective, right, UOB actually looks the strongest, right, with DBS actually the weakest for now, in the technical perspective, all right? Okay, I'm just going through the last few charts, all right, the technical analysis for S&P, all right, this was just updated the day before, so it doesn't take in last night's trading. But we can see around 4,000. All right, that's one key resistance that it cannot break through yet. All right, there's a few resistance over there. Right, horizontal 200 EMA. All right, the short-term downtrend line also they have drew. Right, it's also actually resisting it. Okay, but the good thing is actually forming a bit of a higher low. All right, and if the market actually start to trend around here. All right, because April technically is in terms of seasonality, all right, it's a higher month. So stocks usually perform better in April. So the good thing if the market starts to hover here, and if we go for a breakout, we might actually see a good April. All right, because most of the bad news, most of the uncertainty is already out. Okay, so the Fed also only said one more rate hike. All right, this is closing. All right. Okay, for Nasdaq, all right, we can actually see it's a bit more bullish. It's actually above its 200 EMA. Reason why? Because it's very interest rate sensitive. All right, and now the interest rate is already kind of near terminal rate. All right, so more people are getting back into tech stocks because banking stocks might seem a little bit more dangerous. So people are actually trying to pile back into the tech stocks. All right, and when the economy usually recover, tech stocks also go on the rise. All right. So the good thing is there's always consolidating here. So last night it did not break out also. It's still in the sideways consolidation mode. So hopefully it's waiting for April, and then we might see a push up. Yep. So, but if it breaks the support of around 12580, it's not too good, right? Then we might see actually more downside. How to take this downside? Later I'll get Marcus to cover it. Okay, HSI Tech. All right, this is Hang Seng Tech. Okay, over here also it's a bit stronger than the Hang Seng. All right, we're actually looking for a break towards 4,500. Right, recently you can see Hang Seng is on the run, on the move. Okay, so it's kind of not exactly in correlation with the US market. Okay, yes, it's mind of its own. All right. HSI, very interesting. For the last few days, we are seeing actually a few more green bars, which we haven't seen for the last 3 months. Okay, so this does show a bit of a bullish momentum over here at the end. And we can see that this short-term downtrend line is actually resisting it. All right, the moment we see it break, all right, because there's a congestion of a lot of resistance here, all right, I think we might actually see more upside for the Hang Seng Index. All right, STI, back to our local context, right? Because the STI is actually made out of our 3 local banks. They take on a very heavy weightage, about 40% of the STI. So whenever the 3 banks move, then you'll see STI moving. Okay, it's actually consolidating near the resistance of the 200 EMA. All right, so if there's less banking fears, then we might see our STI starting to inch up. All right, and it needs to overcome this 3236 roundabout resistance in order to see a higher movement. All right, I personally actually use the DLC to trade some of the markets, right? The Hang Seng Index, Hong Kong shares, and Singapore shares. All right, there's a few reasons why, because there's no need for currency conversion. There's also ability to do a bit of contra trading for the week. All right. Okay. If you have anything, all right, we do have a Telegram channel. This is where I actually update our clients of the latest movement, be it Singapore, Hong Kong, or US side. All right. So there's a lot of information. So if you do want, just come and look for me later on. I'll be around. All right. Once again, my personal information. I will pass the time over to Marcus right now.